This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. Treasury sell-off as a hot US CPI data adds to bets that the Fed won't have much room to cut rates this year. Chair Jay Powell telling Congress there's more work to do on inflation. President Trump says he and Vladimir Putin will negotiate an end to the war in Ukraine, reversing US policy over the three-year conflict. And we're live at the Sydney Stock Exchange as Chemist Warehouse goes public after a multi-billion-dollar deal. We'll be speaking with the CEO of their merger partner, Sigma Healthcare.
Take a look at how we're setting up with U.S. futures now pointing slightly to the upside after that very hot inflation report that we got. Strength across the board. We're talking about energy, food, egg prices soaring 15% for the month of January. The caveat, of course, we always see slightly higher prices when it comes to January, given that companies like to raise prices at the start of the year. But really, the broadness of this strength in inflation prices, even before factoring in the threat of tariffs, is really giving some cause for concerns, and investors now paring back expectations of those rate cuts from the Fed. So you could see the 10-year yield soaring past that 460 level. We're talking about potentially 125 basis point rate cuts priced in for this year instead of two before the CPI number. So we had pressure for U.S. Stocks as well. And you can see right there, continuing to see pressure on oil prices sinking after talks of ending the war in Ukraine between President Trump and President Putin, the first known conversation by phone between the two of them. See how we're setting up for the Asian session as well, because as we had that hotter than expected CPI numbers, we also had pressure on the Japanese yen. Of course, rate differentials really playing into the currency here. 154, we could be very close to that 155 level against the U.S. dollar. But this, after significant strength against the greenback for a while for the Japanese yen, especially this year. Nikkei futures pointing to the upside, 0.1%. The staggered open in Australia up 0.2%. But do keep an eye on Nissan and Honda. We do have earnings today. And of course, local reports that their merger might be coming to an end, and that decision could be announced as early as today, Heidi.
Shery, let's get back to some analysis when it comes to the latest inflation numbers and the impact and what to expect from the Fed. QI Research CEO and Chief Strategist Danielle DiMartino Booth joins us now. Danielle, really great to have you with us. When you take a look at the inflation picture, we know that some of these factors are one-offs, like the impact of the devastating LA fires. But broadly, given that we're getting these readings and this sort of heat even before the true impact of Trump's tariffs, does this really complicate the picture for the ability for the Fed to move further?
Well, I certainly think that it makes the Fed's job a little bit more difficult in the near term. But you are very right about the about the one-time factors. We saw used car prices, for example, rise 2.2% on the month. A lot of that was a seasonal adjustment, the same seasonal adjustment that we see come through every February. And we know that we had three massive hurricanes in the United States, in addition to the fires in Los Angeles that caused a ton of replacement buying in December and into January that has since come off. January car sales missed here in the United States. We also had hotel prices spike by 1.7%. And we know that Los Angeles is the sixth largest hotel market in the United States, and that those hotels were really full as that city was largely evacuated. So many one-time things that we've seen. Bloomberg's Anna Wong, however, pointed out that the seasonal factors that were built in showed that the 6-month annualized core CPI had fallen to 3.1% on a 3-month and 6-month annualized basis, with some large seasonal adjustments that we got in going back to 2017. So I think the months that come in the very near term, that inflation is going to become much less of a concern for the Federal Reserve.
Danielle, what about the impact of President Trump's tariffs? Supporters of those tariffs sort of are very sanguine about the inflationary impact. Do we have a clear picture in terms of how sort of structural they will be?
It's very difficult to say because the precedent of 2018, 2019, the tariffs were very targeted. And in fact, what we saw was contracting global trade that ended up manifesting here in the United States as slower growth. We learned that from reading the Federal Reserve's 2019 meeting transcripts just a few days ago. So I think that there are conflicting influences in terms of whether or not we slow growth more because we are a global trade economy, or whether the tariffs do flow through to inflation. In the case of 2018-19, we actually saw the consumer price index drift down as a factor of time as job losses began to mount in 2019.
The issue right now is that it's really difficult to calculate the impact given all of these different policies that the president is pursuing, right? Especially when it comes to also adding the fact that immigration could be tightened. Are there any estimates right now of how the net impact would be when it comes to the U.S. economy, given that the labor markets would also be affected?
You know, it's hard to put all these pieces together because, of course, we did not have the threat of mass deportations when Trump was last taking occupancy of the White House. That is present now, but we are indeed seeing, with revisions to to payrolls numbers, that the construction jobs have actually been cooling. So the risk is not necessarily what you think it might be. In addition to that, Bloomberg does a great job of tracking bankruptcies BCY Go. We've already seen 23 bankruptcies of companies with liabilities of $50 million or more announced this year compared to 14 at the same time in 2024. And we've also had 2,800 store closures announced since the beginning of the year, just since January the 1st. And that compares to about 7,300 for all of 2024. In other words, we have a lot of loosening in the labor market in real time that's going to act as an offsetting factor to what we see potentially with deportations.
Given the risks to the economy, does it make sense for the markets to hedge and just get out of some of those more U.S. consumer-focused names, discretionary stocks, for example, that could take a hit if the U.S. consumer takes a hit?
Well, that is certainly one of the calls that we have this year at QI Research. We did see, the headlines today were filled with the fact that egg prices rose 15% in the month of January. They're up 52% year over year, and yet we only saw spending at restaurants rise by 0.2%, 3.4% year over year. So you're absolutely correct to point out that in areas where we see discretionary spending, we're seeing a pullback on the part of U.S. households. We're also seeing that play out in an increase in U.S. household bankruptcy filings as well. So a lot of concerns here for the consumer discretionary sector. We're also seeing consumer packaged goods companies really take it on the chin as well, because U.S. consumers have become very cost conscious about purchasing brands when they're having to pay so very much for the essentials such as eggs.
QI Research CEO and Chief Strategist Danielle DiMartino Booth, good to have you with us. Thank you so much. And of course, oil also a key factor when it comes to the broader inflationary picture. Well, oil prices sank as President Trump said that he's agreed in a phone call with Russian leader Vladimir Putin to start negotiating an end to the war in Ukraine. It reverses 3 years of U.S. policy on the conflict, with European officials getting no advance warning of the agreement.
I'll be dealing with President Putin largely on the phone, and we ultimately expect to meet. In fact, we expect that he'll come here and I'll go there, and we're going to meet also probably in Saudi Arabia. The first time we'll meet in Saudi Arabia, see if we can get something done. But we want to end that war. That war is a disaster.
Let's bring in our national security reporter, Daniel Flatley. Dan, so much happened in the past 24 hours, especially with that first known phone call between President Trump and Putin. Really lay it out for us what really happened overnight as Asia is now coming back online.
Sure. So, we learned about this midday today. President Trump posted on Truth Social that he had had a long phone call, as he described it, with Russian President Vladimir Putin, and that they had discussed a number of topics, including artificial intelligence and the strong dollar policy of the U.S. and a number of other things. But primarily, he spent most of his post talking about their conversation about Ukraine and the war in Ukraine. Let's not forget that 3 years ago, Russia invaded Ukraine. And so this is the conflict that they're talking about. But Trump said that he would be working very closely with Putin and they would have many conversations about how to end that war, which, as he said in that clip that you just played, he views as a disaster. And he often talks about the many lives that have been lost in the conflict. So, this comes at the same time that his defense secretary, Pete Hegseth, was abroad speaking at an event focused on defending Ukraine and basically ruled out NATO membership for Ukraine. So that is seen by some here in Washington as perhaps giving away some of the leverage that the U.S. might want to have heading into any sort of negotiation over what's going to happen with this war.
Yeah, and what we heard from Defense Secretary Hegseth also gave us more details in terms of what this reorientation of U.S. policy towards Ukraine looks like.
Yes, absolutely. I mean, it's an interesting speech that he gave to the Ukraine Contact Group, which is this group that was sort of convened in the early days of the war to sort of bring together all the allies that are supporting Ukraine to talk about strategy and to basically voice support for Ukraine. What he said, of course, was that NATO membership was probably off the table for Ukraine, but he also mentioned that Europe was really going to need to step up support for Ukraine. And crucially, he said that no U.S. troops would be deployed to Ukraine to maintain any sort of peace agreement or ceasefire agreement there. So, this is read by many here in Washington who are supporters of Ukraine as being somewhat of a giveaway to Putin's position. Others have said, this is kind of an inevitable, not entirely unexpected, I guess I would say, because Trump has not made his position as he has not said, for instance, what the Biden administration said, no talks about Ukraine without Ukraine. So, and the idea of Ukraine joining NATO has always been somewhat of a controversial notion, although the idea that they may be admitted at some point was always kind of held as a point of leverage against Russia. So, a lot of different conflicting ideas here at the moment, but we should know more in the coming days, especially over the weekend with the Munich Security Conference.
NATO has made overtures to the Trump presidency, hasn't it? I mean, it's talked about 20% increase in defense spending. How will this sit with the president, and what more can we expect from European allies?
Absolutely. So, I think that there are some alarm bells probably going off in European capitals as we speak over some of Trump's comments and Hegseth's comments. But they have been trying to show to the Trump administration that they are willing to spend more. This has been a consistent line of criticism that Trump has mounted against NATO, that they're not spending enough for their own defense relative to their GDP. He wants to see that at around 5% of GDP. That's the number that you hear repeated quite frequently. The other thing that I would note is that the U.S. Treasury Secretary Scott Bessent is in Kyiv, or was in Kyiv earlier, talking with Zelensky, really trying to hammer out some sort of a deal over the critical minerals that are in Ukraine in exchange for perhaps some continued support. So, as I said, yeah, there's a lot of different things going on at this moment.
Bloomberg's national security reporter Danielle Flatley. And coming up on the Asia trade, Allspring Global Investments tells us why they think China is well positioned for a recovery. Plus, Macquarie Capital helping us look ahead to Nissan and Honda's earnings reports amid local media now saying that they'll officially call off merger talks today. Much more ahead. This is Bloomberg. Nikkei is reporting that Honda and Nissan will announce the end of their merger talks on Thursday. The presidents of both automakers are expected to hold separate news conferences following board meetings to finalize the decision. This comes hours before Honda and Nissan release their third quarter earnings reports. Bloomberg Global Business Senior Editor Chester Dawson joins us now. Chester, we had heard rumblings of problems in this merger negotiation. So was the writing on the wall? What can we expect?
Well, you're very right. This has kind of been start and stop for weeks. And after their announcement of kind of a shotgun marriage, which neither seem really ready for, they seem to be backpedaling. Obviously, we haven't confirmed this local media report, but it does very much follow what we've suspected, as the two parties don't seem to be able to come to an agreement.
It comes at a time when Nissan is really struggling, right? We're expecting even more dire numbers.
Absolutely. For this fiscal year, analysts expect them to lose close to $2 billion, and that will be the first net loss in about 4 years for the fiscal year. So the company is clearly in trouble. It clearly needs a partner with some cash. There's been a lot of talk. Bloomberg, reported earlier that the head of Honhai or Foxconn is interested in maybe taking a stake in Nissan, and Renault, appears willing to talk about selling its stake, but that's just for about a little less than 40% of the company. So who will step in for the rest remains to be seen.
And it's interesting that even these earnings could reflect the power dynamics in these merger negotiations that caused the problem in the first time, right? Because Honda could be seeing some more rosier numbers, at least, than Nissan.
Oh, absolutely. Honda's in much better shape. And, Honda has expressed some displeasure with the pace of the restructuring at Nissan. Nissan has been in dribs and drabs putting forth efforts to curb some of its production capacity and, cut down on staffing levels. But it's nowhere near enough, seemingly, to placate Honda and make it comfortable before it takes a leap. So it still remains possible that Nissan might come out with a much bigger, broader restructuring, and that the two companies could, forge ahead. But that clearly seems to be something that Nissan will have to do if there's any hope for Honda or even potentially another suitor to come in. They need to see much more intense restructuring before anybody's going to be willing to leap into bed with them.
Bloomberg Global Business Senior Editor Chester Dawson there with the latest. We're staying on Japan, where Softbank has reported a net loss for the December quarter. This as founder Masayoshi Son is campaigning to raise billions of dollars for AI infrastructure in the US. Let's bring our tech reporter Annabelle Jewellers. So let's start off with the earnings. What was really sort of a standout when you take a look at those?
Well, I think it was very much, as you said, there was that net loss for the December quarter, the fiscal third quarter for Softbank. And what really drove that was also the losses for the public holdings in the Vision Fund. And over that 3-month period, there are a couple of names that stood out for really reasons to the downside, because we saw losses in names like Arm, for instance, T-Mobile, Alibaba. These are all some of its top holdings in the fund. Coupang, Didi, another one as well. So lots of different names that were in the mix there. You can see here that net loss on a headline level, but the Vision Fund there were expectations actually it would see a profit of 70 billion yen, but instead it was a loss of near 310 billion yen instead. So despite that, they did actually start to raise investments by a further $5 billion to near $66 billion for Vision Fund 2. And certainly they are sort of shifting the makeup of these vision funds as well. Lots of their resources going towards Son, Masayoshi Son, of course, the founder, but helping him control stakes in key AI technologies.
Yeah, given the ambitions on artificial intelligence, what are we expecting to happen for Project Stargate, given how much these results are not as optimistic as he would have expected?
Well, you've got to say, for someone who's going out to try and raise $500 billion for AI infrastructure in the US, it's not exactly the numbers that you'd want to have in front of investors at the same time. But still, of course, AI was really the key theme of the earnings call. And certainly they're continuing with that commitment. So they spoke about what's the total funding commitment to OpenAI at this date. It's $2 billion at this point. And they are continuing to seek this financing. We were reporting earlier this week that it would be a project financing route as well. But essentially, they're very bullish on the outlook. And they're very bullish on the outlook for OpenAI as well, in particular. Again, interesting given all of this concern around DeepSeek. And would those large language models like OpenAI really be the way forward?
Annabelle Jewellers there. Let's get you to one event that we're tracking at the ASX here in Sydney today. Paul.
Cool.
Yeah, it's a very rowdy ASX this morning because we've all gathered for one of the most hotly anticipated listings of the year. This is the tie-up between Sigma Healthcare and an absolute icon of the Australian retail scene, that is Chemist Warehouse. It's a giant, ubiquitous pharmacy warehouse with more than 500 outlets around Australia. It's listed via the back door, joining with Sigma Healthcare, and in just the past few minutes, the valuation of that new entity hitting $32 billion. I'm going to be joined in a short moment by the Sigma CEO, Vikesh Ramsunder. He'll be telling us what next for this giant of the Aussie pharmacy and retail scene.
All right, we'll be back with Paul in due course, as of course that excitement is building there down at the ASX. But in the meantime, take a look at some of the other stocks that we're watching today. We're just, about 23 minutes or so into the start of cash trading. Treasury Wine, the full year EBIT forecast missed estimates there. And Treasury Wine is one of these sort of China proxies that we look at quite a lot in terms of some of the pressures that this company has been under with that bilateral relationship. And then, of course, the ongoing weakness that we see in the Chinese consumer. We're also watching some of these other names, including Northern Star there. We're seeing just upside of about 0.5% at the moment when it comes to trading in Northern Star. The profit surging on that price rally there. A 155% gain is what we saw in second half earnings. So we're seeing perhaps a muted reaction for trading in Australia's largest gold miners, where they're also preparing to acquire a smaller rival to try and secure more of supplies. We see gold still sitting close to really record prices. Origin Energy is another one that we're watching across that sort of similar landscape across commodities and energy today, with first half net income coming through as a modest beat on expectations. When it comes to Treasury Wine, we'll be hearing from the Managing Director and CEO, Tim Ford, later for an exclusive interview to talk about the company's first half earnings. That's coming up later on Bloomberg TV. Catch it at 11:15 a.m. in Hong Kong, or that's 2:15 in the afternoon if you're watching here in Sydney. More ahead on the Asia trade. This is Bloomberg.
Take a look at how Treasury futures are setting up as we saw the 10-year yield now soar past that 460 level. The best day or the worst day for Treasuries tumbling across the board since the middle of December, when we already had those hawkish Fed signals rattling the markets. This, of course, on that higher than expected CPI print. Strength across the board. Energy, food within core components, super core services prices also showing that higher wage costs are again feeding through to prices. This is Bloomberg.
I'm Paul Allen here at a very loud ASX for one of the most hotly anticipated listings in a long time on the retail scene. Is the tie-up between Sigma Healthcare and an absolute icon of the Australian pharmacy and retail scene, Chemist Warehouse, via a backdoor listing. And as promised, I'm joined here by Vikesh Ramsunder, the Sigma Healthcare CEO. Vikesh, thank you so much for your time on a very, very busy day as well. And already you've rocketed to a $32 billion market cap. It's been December 2023 this plan was announced, so it's been a long time coming. Celebrations today, but what's next?
Well, it's certainly, I think due to competition reasons, we haven't really had a chance to engage with her in more detail, but I think we'll spend some time learning about the different businesses, looking at the opportunities, and then extracting the value from those opportunities into the future. But initially, it's really around integrating the two businesses and understanding them in more detail.
Well, I understand combined your two companies, well, the company now has 1,000 pharmacies in Australia. Everywhere you look, you see Chemist Warehouse signs. Is the market here saturated? Do you look overseas?
No, certainly not. If you look at what Sigma brings along as well, we have the Amcal brand, we have the discount drugstores brand, Chemist Warehouse also has the My Chemist brand, is really trying to understand how we can make these brands work well together and ultimately service all of Australians. So there's almost 6,000 pharmacies in Australia, so it's certainly not saturated.
Obviously, the goal is to lift profitability. I know you're heading into the earnings dark period, or you're already there, but can you give us the long-term view about the outlook, the profitability expectations?
Certainly we've said, bringing the two businesses together once completed, we expect to find around $60 million of synergies, and we'll always look for more efficiencies as well. Chemist Warehouse are really strong in retailing, got great product. Sigma's excellent really around supply chain and distribution, and I think we will look for the opportunities to maximize the benefits of bringing both the companies together.
Of course, because of the sheer size of this new entity, the regulator, the ACCC, took a long time thinking about this, and you did arrive at an agreement where independent pharmacies can leave your network without penalty. How do you see this working, and how are you going to retain those independent pharmacies?
Rightly so. It was such a large transaction. I think the ACCC really did their job in a lot of detail, and we're really glad to come out on the right side of that. But ultimately, it's about adding value, right? If you continue to add value to franchisees, if you add value to consumers, ultimately your business will thrive, because I guess the main function of corporates is to serve your customer. And if we do that really, really well, I see no real risk in losing franchisees and consumers.
This is also a very successful story in terms of being a family-owned business that's now a multi-billion-dollar corporation, but with so many families and friend groups and other associations, how are you going to navigate your way through corporate governance?
Well, we have very strong credentials in corporate governance. Sigma's been listed for more than 20 years. But to deal with the more intricate elements of that, we have an independent board committee that will be dealing with related party transactions, and I remain confident that we can deal with that into the future.
So in terms of sales, revenue, can you give us any guidance around what we might be expecting to see there?
It's very difficult to know, but if you look at the history of this Chemist Warehouse standalone business, they've been growing in double digits, and we will push to make sure that that continues.
You talk about learning between the two entities, Sigma and Chemist Warehouse. What sorts of synergies can you identify between the two?
Well, certainly you've got the duplication of resources from a corporate overhead. You've got duplication of infrastructure in terms of distribution centers, etc. So it's really looking at those opportunities. We haven't even looked at, honestly, we haven't looked at pricing. We have not looked at anything to do with suppliers, etc., etc. So we've looked at the most tangible elements, is how do we get the franchisees and the franchise network really doing well. I'll be the first to say that CW, because I've been competing with them since yesterday, we're far better at franchising than I was, and using that expertise to then help the DDS and the Amcal brands grow offers even further opportunities. So I think very exciting times ahead.
Well, I think that bell signals all the time we have. Vikesh, thanks for joining us. I know you've got a packed schedule this morning, so appreciate your time.
Thank you very much.
That is Vikesh Ramsunder, the Sigma CEO, joining us here. Back to you, Heidi.
It's all happening down at the ASX, and that is, of course, one company, one stock that we'll be watching over the next few days to see the investor appetite. But let's take a look at how we're tracking in Australia sort of a little bit more broadly. This, of course, as we're seeing Aussie stocks really coming off that or building on that fresh record high. Of course, the previous session really being supported by the gain that we saw in Commonwealth Bank. So we're just extending that by just about 1/10% at the moment. When it comes to trading in bonds, they're dropping, tracking US Treasuries. Of course, that hotter than expected inflation print really prompting a reassessment of what traders are expecting for the Fed, and of course the congressional testimony from Jay Powell also feeding into that as well. But here in Australia, when it comes to inflation, certainly the housing affordability side and that crisis will be a major issue in the upcoming election. The nation's two major parties split on how to remedy the problem. For more, let's bring our Australia government reporter Ben Westcott, who joins us now in Canberra. Property is a national obsession, for better for worse, when it comes to the lives of Australians. How are we expecting this to kind of be dealt with, given that affordability issue, be it renting or buying, has reached really fever pitch?
Yeah, absolutely. I mean, we've seen other elections around the world which have been fought over housing, including the UK and very recently the US. In fact, we saw Australia-style policies brought in to the Kamala Harris campaign in a pitch to voters. But in Australia, it is such a huge issue, particularly given the lack of fixed-rate mortgages for many voters, leaving them vulnerable to interest rate rises. But something that has driven Australians nuts for years is just those sky-high housing prices. And just to give you an idea, in major cities since the pandemic, we've seen housing prices go up by about a third. In some cities, even more, 60% or something. So it's just absolutely surging. The average home now is 13 times the average Australian's income. Now, both major parties see this as a problem that needs to be fixed ahead of the upcoming election, which must be held by May 17. Labor is going for quite a holistic approach. They're talking about build-to-rent housing. They've put in place a tax credit for big corporations that want to do build-to-rent housing. And we've also seen Labor putting in place a investment fund, the Housing Australia Future Fund, which invests in housing developments across the country. For the Liberals, the coalition opposition, we're looking at greenfields housing. They want to see more. They've paid for $5 billion of infrastructure to build more housing on the outskirts of cities. And they're also, again, asking voters if they want to take $50,000 out of their superannuation accounts for a housing deposit.
How are economists and analysts seeing these policies? Are they enough to help the Australian economy at a time when we are also potentially headed for a rate cut coming from the RBA next week that could potentially push up prices even more?
Yeah, look, no one is saying that these housing policies are enough. There is still many things that are holding back Australia's housing sector, including a skills shortage, despite the fact that high migration is being blamed for the housing crisis in part. It's in fact still not bringing in enough skilled migrants, things like bricklayers and electricians, that Australia needs to build the homes for people to live in. In addition to that, where the cut to the interest rates might in fact push up housing prices even further, something which people are concerned about. Basically, all economists say that this crisis needs to be solved with big dramatic action, something that we're not seeing from either major party at the moment. And I think voter frustrations over how it's being handled could hand both the Labor government and the coalition opposition a bit of a smack at the upcoming election.
Australia government reporter Ben Westcott there with the latest. Let's take a look at how the currency side of things are doing at the moment as we continue to get that reaction to the faster than expected inflation from the US and this sort of musing over what the Fed can do or the sort of limitations on Fed policy. You're looking at dollar yen sitting at about the 154 level. That rise in Treasury yields is really going to put pressure when it comes to Asian FX, and clearly the yen is always kind of going to be the biggest vulnerability there, right? We're also seeing a bit of a move when it comes to the dollar spot index. Garth Reynolds is our Markets Live Asia coverage, and Garth, you know, it's interesting. There were elements, obviously, to that print. There were one-offs, perhaps, but it adds to the concern, particularly with tariffs and what's going on with the labour market kind of reforms and immigration, that this could be a flare-up of true inflation.
Yeah, well, the building blocks for a flare-up of inflation are there, you know, you could argue that Trump's obsession with tariffs, his determination to introduce those, he's mixing some cement to add some levels to the. I've obviously been influenced by Ben talking about housing, so getting away from mixed metaphors, the basics for a revival of inflation are there. Some of Trump's policies, not only tariffs but also the crackdown on immigration. Those are the sort of things that could definitely help to spur both inflation itself, and also there are signs that they're already spurring inflation expectations. You know, people are looking at tariffs coming in and saying, well, we think that is going to mean higher prices. And that's exactly one of the things that the Fed has been working so hard to remove is expectations for higher inflation. So all of that makes this latest CPI reading very important for the bond market, for those traders who are looking at what the Fed is going to do with interest rates and who are now saying, well, yes, there probably will be one rate cut this year and it will come, you know, towards the back end of the year. So that's, you know, that means that bonds are vulnerable. It also helps to put a bid under the US dollar, though there are other issues that have been going on lately which have helped to make that bid less obvious against some currencies. One currency that's been very obviously driven by this is the yen, which is why it's underperforming in the last couple of days.
Yeah, I mean, the reaction also has been the calculation of where the U.S. dollar could go from here has also been pretty mixed, right? I mean, we have seen that strength, as you said, but Bank of America now saying that if President Trump's policies, especially on tariffs, continue and other countries retaliate, that the dollar could actually weaken from here. What are the views out there on what the greenback, where the greenback would go and what the Asian currencies on the other side of the trade would do?
Yeah, well, the view is pretty mixed. With Asia, it's perhaps a little bit less so, partly because Asia is definitely seen as being more tariff exposed than a lot of places. That's more because Asian economies are a lot of them are very reliant on exports, less because of the China concerns, which have actually reduced recently. Trump has been more willing to target allies than the alleged adversary of China, partly because there are still a lot of tariffs imposed against China as things now stand. But looking more broadly, the concern about tariffs is short-term inflation hit, longer-term growth hit. So, if you add in that expectation that the Fed is going to pause on interest rate cuts, and it's going to be potentially a long pause, that's a long enough pause for policy to sort of slam on the brakes, as it were. It was moving towards easing, but then if you hold interest rates for 6 or 12 months, which is part of what's being factored in, then Fed policy starts to become a growth retardant, and you have the concern that tariffs, and again, the uncertainty around tariffs. If you're a US company and you are involved in anything that involves bringing things into the country and then you're changing those or simply selling those, you're now wondering, am I going to need to deal with tariffs? Am I not? There's a lot of uncertainty there. That can act to retard US growth. The US economy has been so very resilient over the last year, but it's now facing a range of confusing signals and potential headwinds. So that in and of itself undercuts the case for US dollar strength.
Garfield Reynolds, who leads our Markets Live Asia coverage here. And of course, we do have more ahead on the Asia trade. This is Bloomberg.
Take a look at how oil is trading in the Asia session. WTI continuing to lose ground at the moment after we saw it sink in the New York session. Speculation the risks to crude supplies in the region could ease given that President Trump has had that conversation with President Putin to begin talks on ending the war in Ukraine. Not to mention that we've seen this declining trend in prices. U.S. crude inventories have also risen for 3 consecutive weeks. The threat of tariffs also dampening potential demand from the world's biggest nations. Now, the CEO of Brazilian state-run oil giant Petrobras says the company can handle lower global oil prices as President Trump calls on U.S. producers to drill more. Speaking exclusively with Bloomberg at India Energy Week in New Delhi, Shery discusses the Petrobras strategic plan and gives her target for prices.
We are growing our oil production. We are growing our refining products. We are growing our petrochemicals. And at the end of the day, we are not afraid to compete on the international markets. Petrobras has its markets. It's there. And we are not facing problems to put our products and our commodities in the market.
But you see more growth than you had even anticipated last year when you set out the 5-year plan?
No. Everything is solved for us. We produce around 3 million barrels a day. We have a huge internal market. And what we put on the market has a certain place to be. And everything is okay for us.
Do you have a view on where you expect prices to go? Because this is also the year people are expecting that OPEC will restore production. But that is a many trillion-dollar question, really.
No, what we expect by now, after Mr. Trump election, is a little a level of oil price a little smaller than we have been having. So we had in the early month of January something like $80 per barrel. We are now a little less than this.
At about 76,
and,
75, yes.
Maybe between 70 to 75 is our bet. But more than this, wonderful, and Petrobras is very resilient. So everything much less than this, we can survive, and we can put our projects on the markets without any problem. Our calculations say to us that we have been very resilient to oil prices.
So if you expect additional supply from either OPEC or even from the US, and if prices were to go as low as 65, do you expect there to be a significant chance for that kind of fall in prices? And will that make your expansion plans in any form unviable for the short term?
No, our 5-year strategic plan is completely resilient to 65, and I don't believe prices can go much down than this, even because United States has to sustain the unconventional production, so I don't believe in much less than this.
That was the Petrobras CEO, Magda Chambriard. They're speaking exclusively to our colleague Menaka Doshi at India Energy Week taking place in New Delhi. Let's get you the latest when it comes to some of these corporate headlines we're tracking. And Chevron is planning to cut its global workforce by 15 to 20% by next year. The US oil giant employed over 46,000 people globally at the end of 2023, meaning those cuts could affect as many as 9,000 workers. Chevron's vice chairman says the layoffs are part of efforts to simplify its organizational structure and position the company for stronger, longer-term competitiveness. Meta has made a small change to an accounting formula that's likely to increase its profit by billions. The alteration to the formula used to measure depreciation on its expensive AI infrastructure is expected to reduce expenses by $2.9 billion in 2025. The impact is expected to be bigger next year as Meta plans to spend up to 75% more to build out its AI capabilities, Shery.
Heidi, we have breaking news at the moment out of Japan. We are seeing producer prices coming in for the month of January, rising 4.2% year on year. The estimate was for a gain of around 4%. And this is really the fastest acceleration that we've seen since July of 2023 or so. And this coming at a time when inflation in Japan's corporate goods prices have accelerated in recent months. When it comes to the month-on-month number, 0.3% growth in line with expectations. But of course, this as we continue to watch the BOJ's tightening path and what this broader inflation might mean for rate hikes to come. So again, year-on-year growth of 4.2%, a fast acceleration, something that we haven't seen in more than a year. This is Bloomberg.
New Zealand's government has reversed its stance on several climate policies, including curbs on fossil fuels and emissions regulations, since Prime Minister Christopher Luxon's centre-right coalition took office in 2023. Comes, of course, as the US leads a retreat from climate action and as companies push back against the costs of hitting net zero targets. Let's get across to Bloomberg's energy and climate reporter Aaron Clark. So, this from a country that once had, the first legally binding net zero target. So what's triggered this complete retreat in New Zealand?
Yeah, like you said, New Zealand was one of the first advanced economies to set a legally binding net zero target. But since, Prime Minister Christopher Luxon's was elected in late 2023, we've sort of seen this rolling back of curbs on fossil fuels, loosening emissions regulations for the agricultural sector, and also we've seen increased criticism of banks over their restrictions on lending due to climate. Now, Luxon insists that New Zealand can meet a 2050 goal to zero zero out its emissions, though its 2035 targets submitted to the United Nations, which pledged to cut pollution between 51 and 55% below 2005 levels, have been criticized as lacking in ambition. I think what we're seeing from the Luxon government is really a more cautious approach. He was elected on this platform to revive a flagging economy, and it really contrasts with the splashy green announcements we saw from predecessors like ex-Labour Party Prime Minister Jacinda Ardern. And this is an example of the direction that other nations could follow as the U.S. leads its retreat from climate action.
Yes, as you said, we are seeing a wider global rollback.
Yeah, and I think that concerns are mounting among climate advocates that governments globally are faltering on their commitments to lower greenhouse gas emissions. Only a handful of nations met a February 10th deadline to lodge more ambitious national targets with the United Nations under the Paris Agreement. Earlier this week, Bloomberg reported that the Indian government is unlikely to raise its targets for cutting greenhouse gas emissions after rich countries failed to meet its demands for more financial aid at last year's COP29 climate summit. Another example, in Switzerland this month, voters rejected a set of rigid emissions limits proposed by a youth wing of the nation's Green Party, with polls showing citizens remain worried about the impact on jobs and growth.
Right.
So I think what we're seeing, countries are facing choices between immediate economic gains and collective climate action.
Aaron Clark, we're running out of time, but he's the Bloomberg energy and climate reporter as we continue to watch those green policies globally. We're also watching the Japanese yen gaining slightly after that stronger than expected PPI data. The market opens in Seoul and Tokyo are next. This is the Asia Trade. We're counting down to Asia's major market opens, and the reaction to that hotter than expected US CPI print, Haidi, it was really strength across the board, food, energy, core components, and that sent US stocks down. Treasuries also tumbling.
And that's before we even start talking about the potential implications of Trump's tariff policies, of those immigration policies, the sort of flow and effect to the labour market. So a lot of uncertainty in terms of pricing and what the Fed could do. But Shery, we're already seeing the impact when it comes to pressure on Asian currencies, including the yen.
Yeah, we saw that pressure on the Japanese yen, the worst performer among the G10 currencies overnight, and really headed towards that 155 level against the US dollar. Still a little bit of a reversal early in the morning session today because we had that PPI number out of Japan. Producer price inflation accelerating at the fastest pace since June of 2023, 4.2% gain year on year, really beating market expectations, economists' expectations, and the idea right now that the BOJ will continue its tightening path. Take a look at the Nikkei coming online, up 0.7%. We're really looking at Nissan and Honda today. We're expecting earnings out of these two companies, but also local media saying that they will be announcing that their merger talks have ended. The 10-year yield, take a look at that in Japan at that 137 level. We're talking about multi-year highs, of course, and given the expectations of where the BOJ goes from here. Take a look at how the Kospi and the Kosdaq are coming online. They really didn't do much earlier in the week. They were still expecting US CPI numbers, so the Korean won also holding steady, although we're seeing the Kospi and the Kosdaq gain slightly early in the session, Haidi.
Take a look at some of the Aussie assets that we're tracking today, and of course still in the thick of earnings season, so those are really the major companies that we're watching. We're seeing that extension of the record high when it comes to the ASX. Of course, that was driven higher in the previous session, largely on the account of the boost to Commonwealth Bank, that heavyweight, but that is really continuing to play out in this part of the session. We're up by just about 0.25% when it comes to Australian stocks there at the moment. We're seeing some of those financials as well as mining names a little bit higher, gold names in particular, The Aussie dollar is actually reversing some of the earlier weakness on those trade tariff concerns, 62.83, as we see the US dollar also taking a little bit of a breather post the reaction we saw after the CPI numbers there as well. Treasuries at the moment, we're also seeing that reflection in the direction for Aussie bonds as well. That slump now starting to spread to Asia after the US CPI numbers. But take a listen to what we also heard in the congressional testimony for Jay Powell in terms of just the inflation battle and the work that still needs to be done.
We're close but not there on inflation. And you did see today's inflation print, which says the same thing. I mean, we've made great progress toward 2%. Last year, inflation was 2.6%. So great progress, but we're not quite there yet. So we want to keep policy restrictive for now.
Well, joining us now is Alison Shimada, who's a senior portfolio manager and head of the emerging markets equity team at Allspring Global Investments. You're usually in San Francisco, but we are very fortunate to have you here in Sydney. So great to have you with us, particularly on post-CPI day and post Powell commentary day as well. I wanted to start off with our MLive question of the day, which is asking, are traders right to be pricing in one Fed cut? Do you think they should be pricing in any Fed cuts at all, given how tenuous the inflation outlook seems to be right now?
I do think one rate cut is actually reasonable because the course of what could happen in the following year is very uncertain. So, but I do think it's also smart to have come down in terms of the consensus view on an even larger number of rate cuts. I think it's a pause here, and we'll have to see what Trump decides to do in terms of enactment of new policies, and that will have an impact on inflation in general. So I think it's 0 to 1 really this year.
It's interesting if you kind of want to try and get away from either direct US policy impact or indirect impact. China would not be one that seems sort of intuitive, but you guys are actually fairly positive and constructive about the course of the recovery from here on.
Yes, I think the risk is actually to the upside for China because some of this tariff risk is priced in. So, and we've been talking about tariffs in China since 2017. It's not yesterday. So I think that investors and traders in China, in Asia, already kind of assumed 60% tariff hike on day one, which did not happen, obviously. But it could, gradually increase. I think that the other point to make about China is really that they want to have a little bit leverage to do some negotiations with the U.S. and likewise, the U.S. wants to be able to negotiate. And I think from his tone so far, President Trump, it has been obvious that he is treading a bit lightly on China right now. So I think there's room for them to come to the table, and that's what they both like, a proportional response.
Does that make broader EM more attractive? Is China still that strong anchor correlation?
I think it's very, very attractive now. I think last year and the year before we were cautiously optimistic, but I feel very constructive on EM because of this pricing down of all of the securities, whereas I do think in the U.S. it has not been fully discounted. So I think that the pivot should be to looking at the U.S. and what the impact is now.
Which markets are you optimistic about? Because we have seen a lot of concerns about, for example, the Taiwanese market or the South Korean market, which are heavily exposed to trade.
Yes. Well, I feel that number one is China, but besides that, I feel that for other reasons, some of the smaller markets like Poland is very interesting due to the fact that we have additional news on the possibility of the end of the war, and reconstruction opportunities through Poland would be very interesting, I think. So I think that not only that, Mexico, because I think that Claudia Sheinbaum has been very proactive in negotiating with President Trump and has been relatively successful at that, emphasizing cooperation, and they will make concessions because they have a lot at risk as well. So I think, interestingly, things will develop over time. I still think with Taiwan, even though we have a slight underweight to that due to valuation, that so critical and so many advanced technology companies in Taiwan that you really do want to have a position there as well, a very healthy position.
Have emerging markets priced in the fullness of the Fed risk? I mean, you talked about how we were expecting perhaps 60% tariffs on day one, and emerging markets have priced that in. But what about the fact that the Fed might not be able to cut as fast as they want? And we saw this huge market reaction after the US CPI numbers.
Well, I do think that, yes, they haven't nothing is ever fully priced in. There will always be some surprise around various issues. But I do think that the valuation support that we see in emerging markets is much stronger than it is in the developed markets. And I think there's still catalysts for growth, whether it be domestic cyclical recovery, as in China, or also structural growth story in India. There are other catalysts. And I think that they're not as heavily priced they're not as expensive as the U.S. and the rest of some of the developed markets. So I think, we built in a lot of, interest in AI and AI-related companies, and that pushed up a lot of the valuations, and it's normalizing or, coming down a bit, and that is healthy for the markets.
Alison, Shimada, good to have you with us here in Asia, Senior Portfolio Manager and Head of Total Emerging Markets Equity Team at Allspring Global Investments. Take a look at some of the big moves in the Japanese session and this divergence when it comes to how Nissan and Honda are trading. Of course, we heard from local media that these companies will announce that they have decided to end their merger talks. We know that Nissan has been seeing a tough time. We're getting their earnings today as well. It could be posting big losses this fiscal year. They're really embarking on that broad restructuring. Honda, on the other hand, could report a bump in their last quarter profit after weak sales in major markets were actually offset by that strong showing in the U.S. market, not to mention on income from motorcycle business. You can see the reaction right there, Nissan falling and Honda gaining ground. Softbank is another stock that we're tracking right now because we already got their earnings and they reported a net loss of $369 billion for the fiscal third quarter. A big part of it, of course, is that drop in the value of Vision Fund's public holding. Not to mention that they're, of course, again, seeking to finance and raise $500 billion for the Stargate AI project. Let's bring in Bloomberg technology reporter Minjong Lee. Minjong, really the latest results not sitting well at a time when they also have to invest so much money.
Right. It does come at a kind of a bad timing for Softbank, but their earnings, especially due to Vision Fund, has been volatile because they move in line with market share prices. And like you just mentioned, they do need to raise about $500 billion for this Stargate AI project jointly with OpenAI. So we have to see how, but Goto did mention a little bit of how they plan to raise this money, which is going to be focused on what is called project financing with minimum equity from Softbank and OpenAI, which means they won't have to pull in that much cash for initial commitment, which is in line with what we've reported so far. But there's still a lot of questions to be asked.
I mean, John, as Shery mentioned, what are the implications then for Stargate?
Implications that I think a lot of people will be looking at how the cash position for Softbank changes going forward, which is impacted by how the company manages all of its hundreds of startups and other assets.
Our Bloomberg technology reporter Minjong Lee there with the latest on Softbank. We do have more ahead on the Asia trade. This is Bloomberg.
I'll be dealing with President Putin largely on the phone, and we ultimately expect to meet. In fact, we expect that he'll come here and I'll go there, and we're going to meet also probably in Saudi Arabia the first time. We'll meet in Saudi Arabia, see if we can get something done. But we want to end that war. That war is a disaster.
Well, President Trump talking about potential meetings with Russian President Vladimir Putin after they agreed in a phone call to negotiate an end to the war in Ukraine. So this is obviously a decision that reverses 3 years of US policy on the conflict. European officials getting no advance warning of the plan. Let's bring Bloomberg News editor Michael Heath. Certainly a lot of the campaign rhetoric perhaps makes this unsurprising, but it is a significant reorientation of the US approach, right?
Yeah, I mean, and it's really going to be quite disconcerting for Ukraine's President Zelensky, because the relationship between Trump and Vladimir Putin has always been quite opaque. We never really know what the sense is there. People read in a lot of quite negative things. But the main thing's always been that the US has said that Ukraine must be central to the peace process. What this looks like is a former superpower and a superpower sort of going over their head. And as you mentioned, the Europeans weren't given a heads up. So it's, yeah, it'll be a very nervous time. I mean, Trump then spoke to Zelensky afterwards, but it sounds a lot like it's sort of going to be diktat kind of peace, because the main impediment to peace, obviously, is Russia, because it's invaded. So the idea that you ring Putin and worry about people dying in war it's sort of, you know, logically a little bit absurd in its way as well. So, yeah, it's Ukraine's putting a brave face on it, but I think they'd be very disconcerted here.
The Hegseth speech was really interesting and really builds on that.
Yeah, I mean, one of the worrying things here is that there's not a lot of experience of dealing with Russia in any of the national security side of the US, and Hegseth's obviously a neophyte, and you know they're dealing with former KGB agents, and they just seem to be quite sort of almost unrealistic in their expectations. I mean, the notion of saying, you know, outside of talking about NATO and Europe needing to step up, which is all perfectly reasonable, the idea of saying, well, Ukraine won't get its boundaries back before 2014, you know, the pre-2014 boundaries, and that the US won't have anything to do with a security agreement or boots on the ground. I mean, this is just manna from heaven for Russia, because it basically erodes Ukraine's negotiating position. So it's very, very surprising what they're doing here.
What's been the reaction from Ukraine? We've heard that officials have asked the Trump administration as well to let them use frozen Russian assets to buy US-made arms.
Yeah, Shery, I mean, and it's a reasonably, you know, it's a really sensible idea. That money was frozen when Russia invaded, and obviously Russia has done massive damage to Ukraine. So the notion of using this money either to help reconstruct Ukraine or to buy weapons, you know, following President Trump's sort of more transactional approach, would make sense. The problem is, as I mentioned, this relationship between Putin and Trump that's quite opaque. It's quite conceivable that Putin would ask Trump not to touch that money because it's actually Russian money, and that would constitute theft or something, and Trump coming out and agreeing it. Now, this is only speculation on my part, but even the reporting Bloomberg did, there's been no sense that the upper echelons of the administration or the president himself has given this any approval. But certainly if they did, it would make a lot of sense. It would be a new source of funds. It helps the US economy. It allows Ukraine to arm itself. And the key point here is, if you're negotiating with Russia, you have to negotiate from strength. You have to have every point of leverage available. I mean, even when we talk about signing deals or anything like that, these are basically worthless. It's force, it's strength, it's being part of NATO, it's having a US security agreement. That's what Russia will respect, and I think they're going to perhaps learn this the hard way.
We're seeing a very clear theme in terms of how the US under Trump 2.0 plans to deal with the two major conflicts, right? It wants regional players to shoulder more of the burden. In this case, for the EU, how much readiness is there, both financially but also, you know, within the bloc, in terms of there's a lot of fractured views within that?
Definitely. And again, this would, you know, Russia would be very, very happy with this. Look, the US's assessment of what Europe's doing and how it's free-ridden on US support is completely correct. And Europe does need to step up. I mean, this organisation's been around for 80 years, you know, and they're very wealthy countries. Yes, they've got debt, they run huge social systems and that sort of thing, but they are also a long way away. They're trying to develop their weapons manufacturing, but there's going to be a big hiatus between when they can get that up to speed, when Ukraine can get that up to speed. And this is the problem for Ukraine, is this you know, few years in between. So Europe sort of does need to unite and do this. But as you say, can it unite? I mean, you have countries like Hungary, countries like Slovakia that are very pro-Russian, that are throwing up obstacles, and you need sort of unanimity there. So it's going to be a big question for Europe. Is it a trading bloc, or is it something more than that will, you know, support one another? And this is going to be fascinating to watch. But in this case, the US and the Trump administration is right in its criticism, I think.
Bloomberg News editor Michael Heath there with the latest on Ukraine. And here are some of the other stories that we're following. In the Middle Eastern conflict, Israel is said to be pushing to hold on to a handful of its positions in Lebanon. That's even after a request to keep the bulk of its troops in the country beyond next week. That was rejected by the U.S. The reluctance to fully withdraw risks reigniting tensions with Iran-backed Hezbollah and raises hurdles for Lebanon's newly formed government. The planned exit of Israeli troops on February 18th is part of a truce deal brokered by Washington. President Trump plans to attend a meeting hosted by Saudi Arabia's Sovereign Wealth Fund in Miami. An invitation seen by Bloomberg shows Trump is expected to deliver an in-person address during its opening session. Trump has fostered a close relationship with Saudi Arabia, but tensions are rising over his idea to displace Palestinians from the Gaza Strip as part of a U.S. takeover. NASA says Elon Musk's government efficiency team will review payments at the space agency. Acting Administrator Janet Petro told reporters DOGE will look at spending at NASA as they have with other federal agencies. Meanwhile, Musk has made an extraordinary call to impeach multiple judges who are blocking parts of his cost-cutting crusade. Musk's biggest target so far is Judge Paul Engelmeyer, who temporarily stopped DOGE from accessing some Treasury information. Elon Musk's ex has reportedly agreed to pay about $10 million to settle a lawsuit that President Trump brought against the company and its former chief executive, Jack Dorsey. The suit was over the app's 2021 ban on Trump after the January 6 riots at the U.S. Capitol. The Wall Street Journal says Trump's team decided to move forward with the settlement despite the president's close relationship with Musk.
Take a look at commodities, given these ongoing developments when it comes to the geopolitical front, particularly with this reorientation of U.S. policy on Ukraine. That seems like that's a direction that's headed when it comes to the talks with Russia on the end of the Ukraine war. We're seeing oil holding its biggest loss in more than 2 months on the speculation when it comes to risks to Russian supply could ease after President Trump said that he and Vladimir Putin have agreed to talk about ending the war. So we are seeing at the moment New York crude trading just over $71 a level there, fell almost 3% in the previous session as well, the most since late November. We saw some weakness when it comes to the closing price for Brent as well. Those teams would start negotiations immediately, according to Trump, and saying that he would probably meet Putin in Saudi Arabia. Also watching that gas there at the moment as we have EU nations pushing to relax the gas storage target, given that we have seen this price rally. That rally does continue, though. We're seeing that gas futures up by 1.5% as well. With really a scene of rapidly depleting stockpiles and surging prices. Storage sites currently at about 50%, less than 50% full, which is the lowest seasonal level since 2022. More ahead on the Asia trade, this is Bloomberg. Take a look at some of the movers that we're watching. We're just about an hour and a half into the start of trading here in Australia, and South 32 is one of those stocks. We're seeing a little bit of downside, about 0.6%. They are weighing the sale of the Cerro Matoso nickel project on a fall in nickel prices, talking about these structural changes in the market that have now put pressure on prices. So that is one review that we're watching very closely. Treasury Wine is another. This is a very China-exposed company that, of course, went through a really tough time over the sort of COVID and post-COVID period. We have seen that full-year EBITS forecast missing estimates there as well, that guidance missing, as well as just some broader sort of downside in those numbers as well. The premium brands falling by 50% year on year. Sigma Healthcare, that big merger today, is one that we're watching, and we are seeing upside of 3.25%. For more on that, let's bring Bloomberg's Paul Allen, who joins us on the ground at the ASX today. Paul.
Thanks, Heidi. The ASX floor here is emptied out. It was party central when this listing was announced, when the bell got rung. And we've seen a modest increase in the share price, as you mentioned, but the real action was on trading volume. We've seen 70 times normal trading volume in Sigma shares for this time of day. But just to give you a sense of the scale of this tie-up, Chemist Warehouse is ubiquitous in Australia. The yellow and red stores, it feels like they're everywhere. There's huge selection. It has massive scale, about 500 stores nationwide. Sigma perhaps less known, but under its banner are a number of independent pharmacies and a number of other branded pharmacies as well. So combined, they control about 1,000 of the 6,000 pharmacies in Australia, as well as a lot of the wholesale agreements as well. So this is an enormous company with a market cap now rising close to $32 billion.
And those competition concerns really leading to the regulator to take its time in clearing this.
Absolutely. The absolute scale of the Chemist Warehouse Sigma tie-up did have serious implications around competition, as you can imagine. So the regulator did take its time, it delayed its decision, but eventually it was very happy with a court enforceable agreement that any independent pharmacy wishing to leave the Sigma banner could do so without penalty, that there were also strong provisions around the supply agreements that Sigma offers to its pharmacies as well. So with that green lit, it was off to the races. And since this merger first got announced back in, I think it was December 2023, we've seen Sigma shares accelerate something like 280%. The founders of Chemist Warehouse, Jack and Sam Gantz, also Mario Verocci, who joined the company as an intern about 50 years ago, they are now each worth about $2.5 billion. So as you can imagine, they're all in a tremendous mood today, and I think they've left here to go and have a very long lunch.
And you can see the stock there gaining more than 3% already. Bloomberg's Paul Allen there joining us from Sydney. And of course, other movers that we're watching here in the Japanese session, Softbank, after reported net losses. We've been watching, of course, the Vision Fund and its drive for its ambitions on AI infrastructure. Nissan down 0.3% still. We're seeing that divergence with Honda. We're expecting earnings from both companies at a time when Nikkei is reporting the Honda Nissan will announce that they have decided to end their merger talks. This is Bloomberg. Nikkei is reporting that Honda and Nissan will end merger talks on Thursday. This report coming hours before Honda and Nissan release their third quarter earnings reports. Let's bring in James Hong, head of Asia Autos at Macquarie Capital. James, good to have you with us. We're seeing really Nissan under pressure today, Honda stock gaining ground. How much does this really reflect the outlook for business for these two companies, especially if we see, in fact, the merger talks collapsing?
Yeah, well, I don't think that today's move really has to do with their third quarter operation result. It's more about the future of the company, especially when it comes to Nissan. With the recent not a report on Honda getting interested, but it's not about acquisition, it's more about partnership, which also means that the burning cash situation of Nissan may not really turn around anytime soon. We are actually expecting more of the self-restructuring plan to be announced, updated in the third quarter today. So I guess the total impact on their balance sheet and cash position will be the key focus. But at the moment, given the hypes we had around these acquisition from Honda or someone getting interested on Nissan, I guess that's basically the dragging down the share price at the moment and hurting the sentiment.
Yeah, so how will Nissan stay above water if this talk, in fact, collapses and there's no merger?
Well, I guess there will be a couple of things to do. I mean, at least the company need to continue to deliver their self-restructuring plan and hoping that they persuade creditors or their stakeholders to continue to support the company. Do note that majority of their outstanding loan is already guaranteed by the Japanese government. So we don't really expect any major related issue, financing related issue anytime soon for Nissan. However, in order to deliver more positive message to the market and basically ease the concern around the sustainability of the business, we surely need to hear more about their outlook and the progress that will deliver. And within that plan, probably the market will want to hear more about partnership, what kind of financial investor they're looking, or how they fund their operation. I mean, these are all the questions that still has yet been answered, and mainly a lot of analysts or investors will probably ask about it today, later afternoon on their earnings briefing.
We have heard that Hong Hai is open to that partnership, right, through buying Renault's stake. Are there other partners or possibility, roads ahead that are available to Nissan that might make sense?
Well, I mean, we've been hearing some of like in Japan market, obviously there are a lot of active private equity funds. So I do hear from some of the investors that there might be a potential target for those private equity. Although we don't see Nissan as a very attractive target. But with the company start to carve out some of the overcapacities and the company want to cut their capacity, I'm sure some of those factories can be sold to the potential buyers. Like it can be Honda, it can be anyone else who are willing to enter the EV assembly business. But again, all these are still remain as an uncertainty to us. At the end of the day, we still believe that Nissan would need to get support from the other big automaker. And without that, it seems to be quite difficult situation for them.
Survival is one thing, right? But, being able to actually regain competitiveness seems like a really big ask at the moment. Does scale on its own through these sorts of, a collaboration or a merger like this actually help it compete with the Chinese manufacturers? Yeah.
So the overall overcapacity situation and the lack of scale actually started with as they lost their market share in China with the obviously competition from BYD or local companies. But at the same time, their response to the changing market dynamic, such as growing demand for hybrid in the US, was actually a bit late. So we're basically seeing the Nissan with the weakening brand power every day. And obviously, on the other hand, we're seeing the Koreans and other hybrid manufacturers in Japan, which is basically Honda and Toyota, continue to do better in the US market. So for Nissan, as you said, sustainable survival was one thing, but the turnaround and becoming a better brand or becoming what they were, 20 years ago, we're still, I don't think there is a lot of we don't have much of confidence on that one yet.
What does this actually mean for the broader auto industry here in Japan and perhaps what we thought would be more accelerating moves towards consolidation?
Right. We don't think that the consolidation is off the table. Given there are many of the Japanese automakers with the lack of scale to invest on software-defined vehicle, we've been seeing BYD basically guiding that all their vehicles, even cheaper ones, will have ADAS function, right, as a basic feature. And also the EV transition competition from Chinese, especially in China and ASEAN, which are basically the key market for Japanese automakers, and the changing environment in Europe and the US. We don't think that subscale company can actually deal with that efficiently. So consolidation is still there. It's just that when you look at the Japanese automotive industry, the major, most of the members are within the Toyota umbrella, like Suzuki, Subaru, Mazda. But the question still remains on the three more independent companies, which are basically Honda, Nissan, and Mitsubishi. And the Japan-French alliance or Japan-US alliance, which is a Honda and GM, has not really been successful. I'm sure there will be a lot of cultural issue between the two automotive groups there. So still from the Japan automotive industry as a whole, we still believe that this consolidation and collaboration within the remaining three companies still a viable option. It's just that the discussion just went that for now, but I don't think there's like permanently gone at the moment.
From a more global perspective, we know that both Honda and Nissan are particularly vulnerable to trade tensions and tariffs, right, because of the high share of those vehicles that get imported to the US from countries like Mexico and Canada. What's your assessment in terms of how big that exposure is?
Yeah, I mean, so not all the Japanese automakers are not free from those impacts to begin with. But when it comes to Nissan, we're basically seeing the larger dependency towards the Mexican operation compared to other companies. I mean, some of the popular models they produce, such as Sentra and Kicks, which is a small entry type of vehicles, are accounting majority of their volume for their U.S. operation. And unlike Nissan, Honda and Toyota still has room to adjust their production and location for those vehicles being produced in Mexico. So that actually puts a different situation. And also, when you look at the Mexican product to the U.S., it's either very expensive pickup trucks like U.S. companies and Toyota build in Mexico, or either low-end passenger cars. So if there is actual tariff against the Mexican product, I'm sure these high ASP products are more when it comes to the customer, less sensitive to those price changes, whereas it can actually be cost cannot be really been passed on to the consumers for those cheaper, who has less affordability when buying the vehicles. So we're more negative concerned about this exposure when it comes to Nissan, who are basically delivering very laser thin margin at the moment, if not negative, for their automotive business at the moment, especially in the US.
James Hong, really great to have you with us as a head of Asian autos at Macquarie Capital. Let's take a look at how we're trading here in Asia, as of course this part of the world and these markets wake up to really that hotter than expected US CPI print, the repricing of Fed expectations, and some of the commentary that we heard from Fed Chair Powell about the work that the Fed still has to do when it comes to battling inflation. A lot of those moves that we see are across the sovereign yield curve there, as we saw that Treasury slump really spreading now to Asia after that data, as we see Australia and New Zealand yields edging higher after those Treasury yields advanced really across the curve. And we saw that big move when it comes to Japanese bonds today as well in the session. So we continue to watch for that. The dollar is taking a little bit of a breather after the initial reaction and taking some of the pressure off some of the Asian currencies, including the yen. More ahead on the Asia trade. This is Bloomberg.
We're following prices worldwide. India, for example, we saw the rate easing to 4.31% in January. That was a 5-month low, driven by a significant easing in food prices. The Reserve Bank of India is expected to continue lowering interest rates in the coming months. Of course, we have seen that significant pressure for the rupee as well, although earlier this week we actually saw a jump and seen the biggest rally in more than 2 years, with sources saying that the RBI actually intervened in the FX markets to curb speculation on the rupee. That surprised traders a lot, because people were expecting the RBI to be a little bit more hands-off when it comes to the currency. All of this coming at a time when we're also expecting President Trump to meet Indian Prime Minister Narendra Modi on Thursday in Washington. Modi is likely to face a minefield in negotiations with the president, who has signaled that India remains a potential tariff target. Bloomberg's Avril Hong joins us now with a preview. So, Avril, this meeting, of course, comes when trade tensions are high around the world. What can we expect from the two leaders?
Yeah, I mean, you look at the trade backdrop between the US and India. The US runs a trade deficit with India, and we've also heard how Trump has called India a very big abuser of trade ties with the US. You talk to economists from Morgan Stanley to Nomura, they'll tell you that among the nations most vulnerable to reciprocal tariffs, they cite India. Simple reason, when you look at the tariffs that India levies on the US, they're on average higher than what the US levies on them. So I think it's fair to say that Modi is likely to try very hard to convince Trump to avoid tariffs. And we've seen him kind of take some of these preemptive moves in recent times, taking in undocumented migrants, slashing tariffs from bikes and cars, and also trying to push for the ramp up of bigger purchases of US energy. Apart from Modi, I think the investor community also would like to see more clarity on tariffs, top of mind for them as well. You look at, in terms of the stock market, foreigners have pulled out since the end of September about $21 billion from India. Some of this because of its growth miss and concerns about overvaluation. But certainly, India's stocks could use more clarity when it comes to tariffs. But it's really worth keeping in mind that when you look at the tone of their meeting this time around, it's decidedly different from, say, 5 years ago when Trump and Modi last met in Modi's home state of Gujarat, where Trump received sort of like a rock star welcome, or even from 2 years ago when Modi was last in the US. This time around, US-India ties have been strained because of this massive Adani bribery case.
And on that case, right, Gautam Adani has been doing a lot of foundational work in the US over the past few months. Do we expect this to play into all of these conversations?
Yeah, I think sources have told Bloomberg that even if the two men don't discuss it, their entourages might. I mean, just taking a step back, this was a case that was brought on by the Biden administration's Justice Department against Gautam Adani, Asia's second richest man, a close associate of Modi. And we've seen and known that this was going to take a long time to prosecute, and that since land on the Trump administration. So amid all this, we've seen, according to sources, Adani really trying to build political influence via lobbyists, via law firms, to try to, I suppose, sway the White House, avert a U.S. conviction, the worst financial fallout for his group of companies as well. So that is what we're seeing based on Bloomberg sources. We're also seeing how recently a growing number of Republicans have weighed in, saying that, this case is detrimental to U.S.-India relations, and Trump himself has also recently paused enforcement of a law that would have, barred U.S. firms from bribing foreign officials. So very possible that this is going to be discussed between the two men, or at least their entourages.
Everyone there with us with sort of a preview of what to expect. And Bloomberg's Haslinda Amin has an in-depth conversation with the matriarch of Asia's richest family in the latest episode of Latitude. Nita Ambani talks about leading the joint venture with Disney, backing India's Olympic hosting bid, and responds to critics of the lavish wedding of her youngest son. Tune in at 8 p.m. Thursday Hong Kong time for that very wide-ranging conversation. Let's take a look at what we're seeing when it comes to trading across commodities. Oil is, of course, one to watch as we have these ongoing developments when it comes to what happens as we get these potential talks to end the war in Ukraine between President Trump and Vladimir Putin agreeing to have those talks and raising speculation that risks to Russian supply may soon ease. We've seen, of course, US sanctions on Moscow's oil sector disrupting the flow of Russian crude. That's really underpinned a lot of the gains that we've seen in global oil benchmarks this year so far. We are seeing New York traded crude off by a bit at the moment. We're also watching some of those other asset classes, including nat gas, on account of potentially some storage changes in the European market. More ahead on the Asia trade. This is Bloomberg.
Here are the latest corporate stories that we're tracking. Chevron is planning to cut its global workforce by 15 to 20% by next year. The U.S. oil giant employed over 46,000 people globally at the end of 2023, meaning the cuts could affect as many as 9,000 workers. Chevron's vice chairman says the layoffs are part of efforts to simplify its organizational structure and position the company for stronger long-term competitiveness. Meta has made a small change to an accounting formula that's likely to increase its profit by billions. The alteration to the formula used to measure depreciation on its expensive AI infrastructure is expected to reduce expenses by $2.9 billion in 2025. The impact is expected to be bigger next year as Meta plans to spend up to 75% more to build out its AI capabilities. Apple also giving Android users access to its TV Plus video service for the first time in a bid to boost its streaming subscriber numbers. The TV Plus app is now available on the Google Play Store, marking a rare time Apple offers services on the competing platform. The streaming service had been restricted to Apple's own operating system and third-party platforms. Bloomberg has learned that Beijing is working on a proposal to help China Vanke plug a funding gap of about $6.8 billion this year, signaling a potential rescue for the distressed developer. Let's bring in our China correspondent, Mingmin Lo. Mingmin, so what do we know about this plan?
So we are hearing from sources that the government is mulling allocating about 20 billion yuan in local government special bonds to buy up unsold homes and vacant land from Vanke. This is to plug a funding gap of about 50 billion yuan that Vanke faces now. And we're hearing that Vanke may also be allowed to tap on other financing sources such as loans or issuing new bonds. And this comes as the company last month issued a warning that is facing record losses of $6.2 billion last year. It's facing a huge wall of debt, about $4.9 billion worth of bonds that are maturing or facing redemption options this year. Plus, on top of that publicly issued debt, it also has private debt, about 91 billion yuan of loans outstanding by the end of March. So this is a pretty significant move, suggesting that it's quite a shift in stance, because what the government is mulling to do now is really quite different from what they did when other private companies like Evergrande were facing default risks, and suggesting that perhaps Vanke is that line in the sand that Beijing seeks to protect when it comes to these state-owned or state-backed enterprises.
Yeah, this idea of being too big to fail, right? Although I think a lot of people always felt that way about Evergrande. We saw this lifting some of the other property players as well. Does this mean that the market expectations are kind of set that we won't see any more SOE property developer defaults from here on in?
I think that is the market expectations based on what we are hearing from sources, but it's a bit early to tell as well. But we did hear the government telegraph that they were going to widen the use of local government special bonds to buy up unsold homes to support the property sector. And I think this is the first time we are hearing of a very specific way of how they plan to implement this, with very specific quota for a targeted company in this sense. But as I said, it is a situation that is developing. The housing crisis in its fifth year now, and authorities trying to ring-fence this spread of contagion from spilling over to the state-owned enterprises. And there you can see the big market moves. Vanke stocks up by double-digit, and you're seeing that reflected in the Bloomberg index of real estate developers, in the Hang Seng property index as well. And here we're showing the Vanke bonds recovering from distress levels, now just hovering above the 70 mark, about 74 cents on the dollar, and certainly expectations that maybe we could see the line being drawn for these big state-owned enterprises like Vanke, like Poly Developments and other state-backed companies.
Bloomberg's China correspondent Min Lo there, and as Min mentioned, we're going to be watching the likes of Vanke and some of those peers to see if we see another uplift today when it comes to those property stocks. Take a look at what we're looking at when it comes to futures for markets about to open in sort of the next half hour or so. US futures looking pretty positive, about 0.25%. This is, of course, really the previous session was focused on that heavy sell-off in government bonds in the US. That steadied somewhat in the Asian trading session after, again, the higher than expected US inflation numbers. These bets of the Fed Fed won't have much room to ease this year. Taiwan futures, TAIEX futures, I should say, up by about 0.4%. We're also seeing FTSE A50 China futures, the last trade, in the positive as well. We'll be watching Hong Kong China stocks as well. The Hang Seng China Index, really since we saw the bottom exactly a month ago today, it is now the world's best performing major stock index. So how much further upside do we see for some of these China stocks? Alibaba is also one to watch as well, as we've seen that sort of DeepSeek related AI momentum driving a lot of these names higher as Alibaba Group's Hong Kong listed shares have surged almost 50% from that 2025 low in January. Shery.
And we have seen the surge in the Japanese markets in today's session as well. Every sector in the green, despite the fact that we're seeing a lot of fluctuation in the Japanese yen. Of course, really pressured by the fact that we got hotter US CPI, rate differentials playing in. Then we saw a little bit of a boost after we saw the PPI numbers here out of Japan accelerating more than expected. Fastest pace since June of 2023. Right now holding steady as every sector on the topics is also on the green. The Kospi being led down by consumer staples and financials. That's it from the Asia Trade. The China Show is next. This is Bloomberg.